22 retirement strategies went into the model: annuities, dividend portfolios, rental property, gold, the bucket method, all of it. Most of them worked. At least, that's what the surface numbers said. Then we ran every one of them against the same household. Same savings, same income, same 30-year retirement, and 19 of them barely moved the ending number at all. 3 did. Those 3 moved it more than the other 19 combined, and every one of them is boring enough that almost nobody makes a video about it. Quick note on what testing means here, because it matters. This isn't a personal story about a portfolio. Every strategy in this video got run through the same model on the same hypothetical household, using published 2026 IRS and Social Security figures. One household, $400,000 saved at 60, 25 years of retirement. Every strategy judged on one question: how much more money ends up in their hands after tax and after fees? 19 answers came back somewhere between disappointing and rounding error. Let's start there, because knowing what doesn't work saves you more time than knowing what does. Rapid fire, and I'll be fair to each one. Dividend investing. A dividend is not free money. It's your own capital handed back with the share price adjusted down to match. Fine strategy, not a needle mover. Annuities. They solve a real problem, which is outliving your money, but they buy certainty rather than growth. You're paying an insurance company to take a risk off your plate. Rental real estate. It worked in the model, but only when the household was willing to be a landlord at 78. That's a job, not a strategy. Gold and precious metals. Zero income, storage costs, and a price driven by fear. It held value. It didn't build any. Crypto allocation. Enormous range of outcomes. No reliable planning value at this stage of life. Market timing. Lost in nearly every version we ran, which is the least surprising result in the entire test. Stock picking. Widespread of outcomes. No dependable edge. Whole life insurance sold as a retirement plan. High cost, slow build. It's insurance wearing an investment costume. Reverse mortgages, a genuine tool for a genuine emergency, not a wealth builder. Downsizing the house, freed up cash once, then stopped mattering entirely. Moving to a no income tax state, helped some households meaningfully. Did almost nothing for this one because most of their income was already lightly taxed. Target date funds, perfectly reasonable, and the model liked them. They just didn't separate from the pack. The bucket strategy, mostly psychological. It helps people stay invested, which has real value, but the math is close to neutral. Dynamic withdrawal rules, small, steady improvement over a flat 4%, small being the operative word. Automatic rebalancing, same story, chasing higher bond yields. Picked up income, picked up risk, roughly canceled out. Side income in retirement. Worked, obviously, because it's just more money. But it isn't a strategy, it's a second job. Paying off the mortgage early, emotional win. Financially, it was close to a coin flip against investing the same dollars. Working 2 extra years. This one actually placed 4th, and it was close. It just requires 2 more years, which leaves 3. Number 3 is the one people dismiss because the number sounds too small to matter. According to Morningstar's 2026 fund fee study, the asset-weighted average expense ratio across all U.S. funds was 0.32% last year, which sounds like a story about how cheap investing has become. But look at the other number in that same report. The equal weighted average, which is what funds actually charge regardless of how much money sits in them, was 0.92%. Meanwhile, the Investment Company Institute puts index equity mutual funds at an average of 0.05%. So the spread between a cheap index fund and an average price fund is roughly 87 basis points, under 1%. It sounds like nothing. Run it. $400,000, 25 years, 7% before costs. At 5 basis points, that household ends with about $2,146,000. At 92 basis points, about $1,749,000. The gap is roughly $396,000. That is the kind of number that makes accountants wince, and the household never sees a single bill for it because it comes out quietly before the return is ever reported to them. And notice what the household had to do to capture that. Nothing. No forecast, no timing, no additional savings. They bought the cheaper version of the same exposure and then went about their lives. What to actually do? Pull up every fund you own and find the expense ratio. It's printed on the fund page, and the whole exercise takes about 10 minutes. Anything charging over 0.5% needs to justify itself with something you can name. Inside a 401k, check the plan administration fees separately, because that's a second layer sitting underneath the fund fees, and it rarely appears on your statement in plain language. Number 2 is the one with a deadline attached, and if you're in your 50s right now, the window is closer than you think. The tax code does something for 4 specific years of your life that it does at no other point, and almost nobody plans around it. Between ages 60 and 63, you are allowed to save more than you have ever been allowed to save. In 2026, the standard 401k deferral is $24,500. Add the age 50 catch-up and you're at $32,500. But between 60 and 63, if your plan allows it, that catch-up jumps to $11,250, taking you to $35,750. Stack an IRA on top at $7,500 plus an $1,100 catch-up, which, by the way, is the first increase to that number since 2006. Then add a family HSA at $8,750 plus another $1,000 once you're 55. $54,100 in a single year in accounts the government is subsidizing. Do it for all 4 years, and that's $216,400 moved out of taxable territory. Left alone until 70 at 6%, it's around $356,000. And then the window shuts. At 64, the super catch-up drops back to the standard amount. Nobody sends you a letter about this. The reason this ranks so high isn't the deduction, it's the timing. Money contributed at 60 still has a decade or more of compounding ahead of it, and it goes in during years when household income is often at its lifetime peak, which means the deduction is worth the most it will ever be worth. 2 things to check. First, the super catch-up is optional for employers, so confirm your plan actually offers it before you build a budget around it. Second, starting in 2026, if your prior year wages were above $150,000, your catch-up has to go into a Roth account rather than pre-tax. Same money, different tax treatment, and much better to know now than to find out from payroll in March. If this breakdown is useful, subscribe. I run the actual numbers on retirement questions every week with current figures instead of recycled ones. And if you want the claiming piece worked out for your own situation, the claiming order map is linked in the description below. So, number 3 saved money that was leaking out. Number 2 put more money in. Number 1 is different because it doesn't require you to save another dollar or change a single investment. It's a date. Between your full retirement age and 70, delayed retirement credits add roughly 8% a year to your Social Security benefit. Not 8% of a market return that might show up, 8% written into federal law, adjusted for inflation every year afterward, paid for as long as you live. The Social Security Administration's own 2026 maximums show the size of it. $2,969 a month starting at 62, $5,181 starting at 70. Same worker, same earnings record. That's a gap of $2,212 a month, $26,544 a year for life. Now, I'm going to give you the honest version of this because most videos skip it. The person who claims at 62 collects for 8 extra years, so they're ahead for a long time. Ignoring cost of living adjustments, the delayed claimer doesn't catch up until around age 81. But look what happens after that. By 85, the delayed claimer is ahead by roughly $113,000. By 90, close to $246,000. And there's a second effect that never shows up in break-even math. Whichever spouse earned more, their claiming age sets the survivor benefit. When one of them dies, the household keeps the larger check and loses the smaller one. Delaying doesn't just buy a bigger check for you. It buys a floor under whoever outlives you in the years when they're least able to go back to work. What to do about it? Pull your estimate from your My Social Security account and put the 62, 67, and 70 figures side by side on one page. Then work out what would have to cover the gap if you delayed. because the real obstacle here is almost never the arithmetic, it's cash flow in the years between the last paycheck and the first benefit check. And that problem is usually solvable with the accounts from strategy number 2. Run all three together on the same household and they don't overlap, which is exactly why they came out on top. The fee fix was worth about $396,000, the catch-up window, roughly $356,000 by age 70. The claiming delay, around $246,000 by 90. Add them up and you're approaching $1 million of difference in one modeled household, from 3 decisions that require no market prediction, no new product, and no luck. One plugs a leak, one uses a window that closes, one changes a date. That's the whole thing. Now this is a model, not a prophecy, and your situation overrides all of it. That break-even age around 81 cuts both ways. If your health or family history points to a shorter retirement, claiming early is often the better call, and there's no shame in the arithmetic. If you have no way to fund the gap between retiring and 70, delaying isn't a strategy, it's a cash flow crisis. The catch-up window means nothing if the money isn't there to contribute, and a higher cost fund is worth it if it's genuinely doing something a cheap one can't. Several of the 19 I dismissed are the right answer for somebody, they just weren't the biggest lever for this household. Screenshot this. 3 actions, all doable this month. Check every expense ratio you own, and anything over 0.5% has to earn it. If you're between 60 and 63, confirm your plan offers the super catch-up before the window closes. Then pull your Social Security estimate and put 62, 67, and 70 next to each other. None of these is exciting. That's rather the point. The strategies that get the most airtime are usually the ones somebody is selling. Subscribe, and next week I'm taking the 4th place finisher, working 2 extra years and showing why it came so close to beating all 3.